Thank you for joining me on this video. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. And this is session 4 of 4. And what we're doing is a review of this last 13 days, basically. And this is part of the coronavirus downturn, as I am calling it. And we're taking a look at different aspects of investing in the stock market, including the bond market and things, and how all of these different areas have performed during this downturn, which started with the market peaking on Wednesday, February 19th. And this is session 4. Now, in session 1, we looked at equities and we looked at the S&P 500 versus other investments, including international equities and how those have all fared. And then in session 2, we took a look at alternatives. We looked at the S&P 500 versus gold and gold miners versus high-quality government bonds. In session 3, we reviewed the underlying sectors of the S&P 500 and how they have performed since the market peaked on February 19th. And then in this session, we're going to be talking about some of the most important support areas within the S&P 500. And we're going to be talking about where we go from here. What are the statistical probabilities, and what are some of the underlying and very critical support areas that are beneath where we are currently trading. For this review, we will be using stockcharts.com. That is the charting service that I pay for, and I will leave a link to their site in the description box below this video. Now, let's start off with where we've been, and this is a 1-month chart where each candlestick represents 1 hour of trading in the S&P 500. So you can see here we were coming into, just a nice little steady incline, and we got to this point here, February 19th, where we peaked and closed at 3386.15. So that is the all-time closing high for the S&P 500 up to this point. And again, that was on Wednesday, February 19th, where we closed at 3386.15. And this blue line represents 3380 on the S&P 500, and you can see this is the only time we've closed above 3380. Now, just to kind of review what has happened and set us up for where we might be going, on Thursday, the 20th, we had a negative reversal in the stock market where we did not hold that 3386.15 all-time high. We gapped down, and we still closed above 3370, which up to that point had been acting as a short-term support area. But then the very next day on Friday, that didn't hold, and we closed on Friday, February 21st, towards the lows of the session. So this little pattern here definitely was negative, and I had mentioned to my subscribers of my Simple Market Signals newsletter, which I sent out on Saturdays, I had mentioned that this was a very negative pattern, okay? And I warned my subscribers to take profits. And I'd been warning people for weeks that are subscribers to my newsletter, guys. I'd been warning them for weeks that some of the key indicators within my model, which I do call Simple Market Signals, the model itself, it's a model I built for my own personal trading and investing, and I'm sharing it with you guys via my newsletter. But I had warned people for weeks that some of the key indicators within my model were peaking, hitting the area where they normally stop before they roll over and we have a downturn. So I had no idea, right, that it was going to be the coronavirus that kind of triggered some of this, and that, that the downturn was going to be so violent. And by the way, this next week where we fell over 10% was the fastest correction in history. We had never gone before, up to now, we had never gone from a peak in the markets to a 10% or more drawdown, which is called a correction. Anything over 10% is a correction. Anything over 20% is a bear market. And I'm going to show you the area that we'll have to hit to get to a bear market if indeed things continue to get worse. So, but I had no idea that it was going to happen this fast, but my model was telling me that we were probably going to have a correction sometime soon, and that's why for the last couple of weeks over here, I'd been warning people. And then once I saw this negative pattern, again, I warned my subscribers over the weekend. And then on Monday, the 24th, where we gapped down, there was another signal. I sent out another special midweek update to my subscribers, letting them know that one of the major signals in my model had changed, and that it was time to take cover, right? just so you understand, Simple Market Signals subscribers, and guys, it's less than $20 a month for my newsletter. I'm inviting you to become a subscriber. I'm telling you, it's costing you money not to be a subscriber to this newsletter, okay? So just bear with me here, but I just want to drill down on this because I want you to succeed. And the best way I can help you is if you are a subscriber to my newsletter, okay? But as you can see here, we hit this 28.55 84 intraday low on Friday, February 28th. That is very critical. Just keep that number in mind, 28.55.84. Just remember 28.55, right? It's good enough. But that is, so far, that is the low of this correction, this downturn so far, okay? So that was on Friday, and then the 28th, and then we finished up a little higher than that, and then we went into this next week. And over this last week, predominantly most of the trading was between 3,000 and about 3,100, okay, clear up to 3,120 or so, 3,130. But, 33,000 had been acting as a nice little support area for the markets for most of last week. Of course, Friday, the 6th of March, we traded below that and gapped down, and we closed at 29.7237 for the week. And, on Friday alone, we were down 1.71%. And last week, guys, was super volatile. I mean, we had huge up and down spikes. And, but at least we closed, believe it or not, we closed positive last week, 0.61% to the positive. So a little over 0.6% to the positive. That was a pleasant surprise. Let's move on to the weekly chart and kind of look at some key support areas because, look, from what I've been hearing in the news, and I know people personally that were supposed to go to conferences here in the United States. The conferences have been canceled, okay? And when conferences and meetings and seminars and things like that are being canceled, big events that would mean thousands or tens of thousands of dollars of revenue to the hotels that are hosting these seminars, and the people catering it and all that. When you start to see this type of a slowdown in activity, it more than likely is going to impact earnings of companies, which is going to cause their stock prices to continue to go down. So there's so much uncertainty, guys, around this coronavirus and what could happen. Economically, and of course, thousands of people now have lost their lives. Tens of thousands of people are very, very sick with this virus. It continues to spread. I understand that baggage handlers at airports now are being tested positive for the coronavirus. So, guys, we have no idea how this thing's going to play out. So I think the likelihood of the markets going lower from here is very, very high. So what we need to take a look at is what some of the key support areas are. So currently, again, we're trading at 29.7237. So the most near-term support level would be this 29.50 area, okay? And by the way, this is a 2.5-year chart, so the time span is 2.5 years. Each candlestick now is a week. Okay, so each candlestick represents a week. But I've already annotated some of the key support areas that we need to keep our eye on. And the 29.50 would be the most near-term support level that, once we break that, the next area of support, and remember I told you to remember that 28.55 level. 28.55 is the lowest level that we've touched so far during this downturn. And incidentally, it's also the lowest point that we had for the entire month of October 2019. Okay, so this 28.55 level becomes a very important level, and you can see that there was quite a bit of trading in August of 2019 around this level, and then we had trading above and below it in the middle part of 2019. We had a few weeks of trading above 28.55 back in 2018, and and again towards during the month of January of 2018, we traded above for 1 week. We traded above the 28.55 level. So this is a very, very important level, and it is, in my opinion, and based on my technical analysis, 28.55 is the most important short-term support level that we have. So it's very, very critical that we stay above this. And once we break 28.55, I think the next major area of support is going to be around this 27.50 level, and you're going to see that 27.50 becomes very important if this 28.55 level does not hold. 27.50 becomes very important on numerous levels, which will and for numerous reasons, which will make more sense as we go through these charts. So we really need to keep our eye on this 2750 level if 2855 does not hold. And you can see here on 2750, it acted as support and resistance back here in May, at the end of May, beginning of June of 2019. And again, it was kind of a support area during the first quarter of 2019. And going back here, one of the most important things, in my opinion, is that the first time ever we hit 2750 in the S&P 500, and hopefully you can see where my cursor is moving on the left-hand side of the chart. The very first time we penetrated 2750 to the upside was during the first part of January of 2018. So think about this. If we fall down to 2750 or even go lower, what it means is we've wiped out all of the gains that we've had in the stock market since the beginning of 2018. Okay, so that is one of the main reasons, and there's other reasons I'm going to show you on another chart here, but that is again a very, very critical reason why 2750 is super important if we fall beneath 2855. So we've got support and resistance levels here on this 2750, as you can see, but also it would wipe out all of the gains, all of the progress that we've had since the beginning of 2018. So psychologically, that would be very damaging to investors. Okay, I mean, it would hurt our pocket for sure, but it would also psychologically be very damaging to investors. Now, the reason I've drawn this line at 2,700, okay, if we fall below 2,700, that would put us in a bear market. 2708 and change is actually where the number is. So a 20% decline from where we peaked at 3386.15 down to below 2708. I just drew the line at 2700, but anything below 2700 and we are technically in a bear market, which again means we've fallen at least 20% from our previous all-time high. So as you can see, if we continue to fall and if the news continues to get worse about this virus and the fear of the virus causes people to pull back on spending and there's more and more, cancellation of events and people are not spending, that will continue to be, it'll become a self-fulfilling prophecy, right? Where we end up having more and more damage done to stock prices around the globe, which will continue to drive the markets lower, of course, and it'll just feed on itself. We will get into a negative feedback loop, which I think, unfortunately, at this point is very, very likely. Okay, that just looks like that's what's probably going to happen. Statistical probabilities, right? That's the way I operate. And right now, from what we know, from what we can see, and all the unknowns out there, the things that we can think about, but we don't know the answers, and we don't even know, right, how all of this might play out. We don't know all of the damage that might be done, and that fear, that uncertainty in and of itself will help propel that negative feedback loop, which more than likely is going to continue to drive us lower, okay? But just understand, if we fall beneath 2950, probably 2855. If we fall below 2855, we hit 2750. We hit 2750. We wipe out all the gains from the beginning of 2018. We fall below 2700. We're now in a bear market. And if we fall below 2700, guys, I think we probably go back down to 2350, which is where we started this rally, right, from the end of 2018, where we bottomed around Christmas time of 2018 at that right around that 2350 level on the S&P 500. And I think if we do go into a bear market, it would surprise me if we don't get down to this 2350 level, retracing 100% of our prior move, which again started at the end of 2018. Now, in this chart, we're going to be doing what's called Fibonacci retracements on this whole move that we've had from the end of 2018. And the way Fibonacci works is there's key Fibonacci numbers. And guys, it is incredible over time how well this stuff works. I mean, it's kind of scary, and it shows up in galaxies, it shows up in seashells, and it works in charts. I mean, I know just a tidbit about this stuff, but it's absolutely fascinating. And, I wish I could live 10 lifetimes, because this is one of the things that I would spend more time studying, is just Fibonacci patterns and how they play out in life. But it definitely works in charting. So here are some of the possibilities using Fibonacci retracements. And what I did here is I started back at the beginning of this move, okay? And basically with Fibonacci, what you're looking at is retracement levels from between a prior move, between a prior low and a prior high, okay? So in this case, we're going from where we bottomed at the end of 2018 to where we just peaked a couple weeks ago, okay? And so the key Fibonacci numbers, and there's a lot of them, but the key ones for doing charting is a 38.2% retracement, and I know it's small type, and so hopefully you guys can see this on a larger screen, but 38.2% and 61.8%. Of course, if you add those two numbers, you get 100%, okay? So once you make that move and then you draw these lines, you can see here that we are now below the 38.2% retracement of this entire move, all right? So we've already reversed, we've already pulled back about 40%, okay? We pulled back more than 38.2% of this previous move. The 50% level, which is not a true Fibonacci level, but it does come into charting, so it's in the analysis that I've done here. The 50% retracement of this entire move would take us down to 2870.36, and then a 61.8% retracement. And remember, I said 2750 is a key number, right, to keep that in your head. But the 2750 level also represents a 61.8% retracement of this entire move, all right? Now, the exact number is 2746.42, but 2750 is close enough, right? I mean, you know, it's not always exact, but you can also see, interestingly enough, that 2750, 2746.42 level lines up with these support levels that we hit back in May and June of 2019, and also where we were trading at the beginning of March of 2019. So hopefully you guys can see how all of this is lining up and why I say that 2750 is super, super important for so many reasons. And, you know, we'll keep our fingers crossed that we can stay above that. But psychologically, it's going to be very damaging to investors if we fall beneath 2750, because at that point, we've given back all of our gains going clear back from the beginning of 2018. We've lost almost, well, over 2 years, 2.25 years of trading so far. If that happens, we've lost all of our forward progress for 2.5 years, and it would represent a 61.8% Fibonacci retracement of the prior move, which again was from the end of 18 all the way to where we peaked back on February 19th, okay? And if the 61.8% retracement around the 2750 level does not hold, then more than likely, I think we probably retrace all the way back down to this 2350, 2345 level that we hit back in December of 2018. So those are the most critical levels to watch. So guys, you know, I think there's too many unknowns out here for you to be gutsy and taking too many risks with your investment. I also want to encourage you to watch the video if you want more information on Simple Market Signals and how I can help you. I would encourage you to watch the video that will be teed up at the end of this video. And guys, I'm inviting you, please become a subscriber, okay? It's less than $20 a month. Your first 2 weeks are free. You can cancel anytime. Your risk is so low. Your risk is higher. I'm telling you guys, your risk is higher in not being a subscriber to my newsletter than it is in being a subscriber. There's virtually no risk. I mean, it's less than $20 a month. You can cancel anytime. First 2 weeks free. You get a ton of information. You get my best stuff into that newsletter, okay? I put a ton into these videos, but I have to reserve my best stuff for my subscribers, okay? And I want to help you. I want to help you succeed. And guys, these are dangerous markets. We need all the help we can get on any level, all right? And I put over 20 years of my life into figuring out this model. I figured it out for my own personal investing and trading, but now I'm sharing this information with you for less than $20 a month. So I hope this was helpful. Thank you for being on this video. And if you haven't already seen session 1, 2, and 3 of this series, I would highly suggest you go back and watch those videos because there is a ton of information in each session. Thank you very much, and I'll see you soon.